Good morning to the world, to senior traders, SMF pro traders, and everyone alike. What I'm showing here is a $250 call. And what I'm showing you here is the public loved it so much that they were up here at $22 and the low down here was $3.25. They popped them back. This was during that capitulation that got them down there. They were inflated up here, people. And it's people like me and our options trading market maker capabilities, meaning that we're a market maker, which is a totally different breed. But we're a market maker in the pit, and we understand what they do because that's where we come from. We also understand that I'm going to make a market today, even though that Apple's gapping up a little bit from Friday selling, and these were down 325. They were 1075. The low was 590. I'm making a market at 510 by 550. That's one market. The next market is 630 by 660. That's the first chamber. There is another market below the market, and that market will be 410 by 450. And 410 is bid, 450 is the ask. That's the market. We make the market. We have a mathematical options platform that tells us exactly where that market is made before it gets to that dollar price level. And the value will gap up in the call. And basically, I can show you here now that the $250 call is at 253.82. And this is options expiration. What they like to do is shake the people out and bring this down, bring the equity down as close as they can to the strike, steal all the premium out of here, and that's where you buy 20 contracts and take a $2 move or $3 move intraday. So I made the market. It's very careful to watch these markets during this options expiration. And this options expiration is the most ruthless 5-day period. These calls were so inflated up here that they got down to the deflated area, which is here. And this is the second area of inflation right here. Inflation 1, inflation 2, and they're not viable because what happens is every market makers short the contracts against the public. That's why they go down like that, but we're not going to talk about that. You can talk about that when you're in the school. There's things you don't even know, and if you did know, it will just blow your mind. But we're here, we're a trader on this week. What you see today and what you might see on Friday, you might see the very same contract right here at 2.5 by $3. True story. And the thing about it is, during options expiration week is the best week to be the trader. You're going to get all the prices, all the crap was taken out. It came down. They're coming back down in here in the deflated area, and all of the volatility is out. It's one of the best weeks is to trade the expiration and itself, and even on Friday. So we're making a market on that one. We're making a market on several others that I gave out. We're making a market on the $75 call right here on BIDU. That was up here at $8 and went down right here. $1.40 low. But that's where they were. And they gapped them down, and they took all that premium out, and the BIDU premium is at the deflated zone. And we are making a market for the expiration. Day 1 through 5 days. You can see the market maker gap right here. Not huge, still a gap. I want the pro traders to take their closing price and start working their mathematical entries accordingly. Another thing I want people to do is that when I tell you to buy the calls, we already created that market. We have bids on that market. No one is allowed to enter a trade without telling the floor manager here first. and that is me. Okay. Um, that's on the options. Here is the equity on a daily level. I want people to know that down here, if we set an alarm at 71 and a quarter, that's right above the 10-day simple moving average. Brian Plain, it's worth setting the alarm.